Assalamualaikum, morning. Sihat semua hari ni?
Morning.
Doktor.
Okey, saya bagi tengok muka saya sikit. Saya baru bangun tidur. Assalamualaikum Dr. Zul.
Assalamualaikum warahmatullahi.
Sihat hari ni?
Alhamdulillah. Baru lepas breakfast.
Breakfast apa?
Nasi lemak.
Alah. Ai nasi kerabu lah. Sedap.
Buat saya masak nasi lemak. Satu. Hari ni 5 grup kan?
Hari ni 5 grup. Sebab tu kita start awal sikit, takut tak sempat. 11 dia orang dah kelas. Okey, baru 27 orang. Tunggu sekejap lagi.
Melissa ada ke? Ada okey kan Melissa?
Okay, I think the first group you can share screen now.
Doctor. Hello, Doctor. Can you hear us?
Yeah, loud and clear. Okay, kita tunggu 2 minit lagi ya. Sebab
Okay.
baru 29 orang. 8:35 we start.
Okay, Doktor.
Okay, you may start now, group Ashwin. So this is the 5th group.
Betul, can you hear me?
Yeah.
Okay, I start now, yeah. Assalamualaikum and a very good morning to Dr. Zahira binti Yahya and Surveyor Zulkifli Isha. We are from Extra Solutions in Riam Berhad. My name is Muhammad Afiq Daniel and together with my team members Lee Min Yao, New Lee Guan and Aswin Kumar, we will present to you our business valuation report of Post Malaysia Berhad. Next. The first one is our terms of reference. We have been appointed by Datuk Yasmin binti Mahmud, the independent non-executive chairman of Post Malaysia, to assess the intrinsic value for sale purpose. Next. Our subject of valuation is Post Malaysia Berhad and the purpose of this valuation is sale purpose. The date of valuation is 2nd November 2020 and the industry segmentation for our subject is transportation and logistics. Next. The next one is we have the basis of value and premise of value. The basis of value is intrinsic value where it is a measure of what an asset is worth or the true value of the company. The premise of value is going concern value. Going concern value is assuming that the company will remain in business indefinitely and continue to be profitable. Next. Company background. Post Malaysia is a public traded government linked company. Post Malaysia was founded in 1800s and it was listed on Bursa Malaysia on September 2001. Post Malaysia connects the nation with over 200 postal operators globally. Next. For the next slide is core businesses. Post Malaysia core businesses are postal services, courier, logistic and aviation. For postal services, they deliver postal related products and services and also customized retail solutions. For courier, Post Malaysia offers express parcel delivery service involve receiving and delivering parcel items. For logistics, Post Malaysia offer haulage services, freight forwarding, shipping or agency, chartering, warehousing and distribution. And the last one is aviation, where this service offer air cargo handling, in-flight catering, aircraft maintenance and engineering, and facilities equipment. Next. Post Malaysia also have other businesses which are international. In international, where it has ship e-commerce, where they ship items from China to around the world. They also have Post Al-Rahnu, Post DigiSearch, and Data Post. Next. Operation review. Let's see the first one, which is earning before interest taxes, depreciation and amortization, which is EBITDA. As we can see, the chart shows that Post Malaysia has the lowest EBITDA in 2019 compared to the previous year. The next one is the profit loss before tax. Post Malaysia recorded a loss before tax in 2019 compared to profit before tax in 2018. Post Malaysia also recorded loss after tax and loss per share for 2019 compared to 2018. This was mainly due to an impairment in goodwill, a one-off aircraft redelivery expense, and continued loss in the postal services segment. This was further worsened by the increased cost due to international mail charge and staff costs. Next. National economy. As we can see, GDP posted a smaller decline of 2.7% in Q3 2020 due to COVID-19. However, during MCO, e-commerce and e-fulfillment services are essential and allowed to operate. This has increased the number of parcels delivered in Malaysia and international mail and deliveries can be suspended. Next. The graph shows the contribution of e-commerce to the GDP Malaysia from 2015 to 2018. As we can see, every year there are gradual increment. The forecast for 2019 and onwards were reported to be in positive manners. Next. Even though the graph before shows the number is growing, but Post Malaysia have a lot of progress to make with industry condition and outlook. The first one is low entry for market requirement. Since it is easy to open delivery services for people who has a vehicle, there will be many companies in the market. The next one is the mistake and delay. When the e-commerce has gained attention, many people tend to use this platform. So there will be a lot of mistakes such as a documentation mistake, system failure, and many more. So this will cause a bad reputation to the company services. And the last one is there will be a major threat sourcing from automation, self-driving vehicle, artificial intelligence, AI, and machine learning. Next. These are some of the competitors in the transportation and logistic market. So next, I will pass to Ashwin Kumar to continue this presentation.
Thank you, Daniel. So I'll be continuing to explain comparable use for this particular calculation to derive the value of Post Malaysia Berhad. So there were three particular companies selected as comparables. Firstly, GD Express Carrier Berhad. Secondly, Tiongnan Logistics Holdings Berhad. And thirdly, Nationwide Express Holdings Berhad. These were the only three companies in KLSC that shared similar core businesses with Post Malaysia Berhad and also had a pretty much close resemblance to Post Malaysia Berhad, as we need similar companies to use for our market approach and as well as other approaches. So I will continue to explain about market cap of each of the companies. So GDEX had a market cap of 1.494 billion, and Tiongnan Logistics had a market cap of 211 million. Nationwide has a current market cap of 31 million. Our subject company, Post Malaysia Berhad, sits nicely in between GD Express and Tiongnan Logistics with a market cap of 800 million currently. And next, I would like to invite Niniao to explain further for common size financial statement analysis and financial ratio analysis.
Thank you, Ashwin. Now I will explain on the common size financial statement analysis and financial ratio analysis of the company. So first, let us look at the horizontal common size analysis of Post Malaysia Berhad. This is important for us to establish a trend for the internal performance of the company. So first and foremost, looking at the revenue of the Post Malaysia Berhad, it obviously shows that most of the profit, gross profit, operating profit, and profit before tax has shows a negative trend, and especially for 2018 and 2019, it has the most drastic changes in percentage due to the negative earning in 2019. Moving on to cash and marketable securities. Overall, the cash and marketable securities of the subject companies has shows a downward trend in general. This shows that the Post Malaysia Berhad has less cash in hand, which is the most liquid asset for the company. As for the reserves of the company, it's showing a downward trend from 2015 to 2019. This is due to the decrease in earning from year to years, and this has causing the total equity of the company to decrease as well. Moving on to the liabilities, the company has shows an upward trend in taking more short-term debt and also long-term debts. This has causing the total liabilities to increase. Overall, the performance of Post Malaysia Berhad is fluctuated from 2015 to 2019. And then now we will analyze Post Malaysia Berhad from the perspective of industry. In terms of generating revenue, Post Malaysia Berhad, it can say it's not performing well compared to the industry, as the variance all has decreased a negative variance. And as for the cash and marketable securities, even though the cash and marketable securities of our subject companies has shown an downward trends during the horizontal common size analysis, however, compared to the industry, it's actually outperformed from to her competitors. As for the total equities, it shows that the negative variance shows that the total equity of Post Malaysia is inferior compared to the competitors in the industry. Due to the increment in the debts, this has caused the total liabilities of the company increase as well. Now we will look at the financial ratio analysis of the companies. So in general, Post Malaysia Berhad is not doing well in terms of the efficiency of in generating the revenue due to the negative trend depletes in the change from year to year. However, the working capital turnover ratios has shows an increasing trend. but this is mainly caused by the decreasing in cash of post-Malaysia Berhad. As for the liquidity ratios, insolvency ratios, and profitability ratios, all of the ratios has decreased a negative trend, which shows that post-Malaysia Berhad has shown a liquidity issue, solvency ratio, and also profitable issues. As compared to the industry, the efficiency ratio of post-Malaysia is considered to be performed quite well, as all of the variance shows a positive percentage. However, for the liquidity ratios, it has obviously shows that post-Malaysia Berhad has some liquidity problem compared to the competitors, even though the ratios has exceed the benchmark of 1.0. As for the solvency ratios, it can show here post-Malaysia Berhad has taken more debts compared to the competitors in the industry. And for the interest coverage ratio has shown a negative variance due to the decrease in earning for post-Malaysia Berhad and increase in interest expenses due to they are taking more debts. And in terms of profitability ratio, since they are having less earning from year to year, therefore the profitability ratios also shows a negative variance compared to the industries. So moving on, I will continue explain on the valuation approach. The valuation approach that we use in this business valuation are asset approach, market approach, and income approach with respective methods. These methods will be further discussed when we discuss until the valuation bookings. So now I would like to pass to AK to continue with the presentations.
Thank you, Min Yao. So I will be explaining the asset approach and market approach, and eventually I will invite Neil Guan to explain income approach and conclude the presentation. So starting with the asset approach, before I start explaining the calculation, I would like to make some pass on information first. So in arriving the intrinsic value using this particular method, normalization to the balance sheet of the balance sheet has been done to the industry standard. And under this method, the assets and liabilities of the company are adjusted from book value to their fair market value and normalized according to market norm. The element that will be normalized are account receivables, cash and market securities, and inventory. Excess earning method will not be applied as there is no excess earning. As the element of intangible asset is included in the balance sheet of the subject company, we assume that the value derived from the adjusted net asset method that we are using has already included the element of intangible asset as well. So moving on with the calculation. So we gathered information from each of the comparable companies from their annual reports, getting all their account receivable, sales, cash, current liabilities, inventory, and sales. And we took the median of the past 5 years for each of the company for each of the elements. So it has been done the same for comparable 1, 2, and 3. And using the median as the gauge, we calculated the proportion for each of the company and derived the industry median. So as we can see, there are industry medians for each of the proportions, and to get the adjusted value of percentage, we deducted the subject company's proportion from the industry median to get the adjusted value. So with the adjusted value, we moved on to normalize the balance sheet. So as we can see, the normalization has been done and the adjustment has been made, and the normalized part will be on the most far right of the balance sheet. So the total asset would be 3.272 billion. So in order to arrive to the RNAV, the revised net asset value, total assets were deducted, all of the liabilities held by post-Malaysia Berhad were deducted from the total asset. So the total revised net asset value would be 1.706 billion. So the fair market value using asset approach would be 1.706 billion, and the intrinsic value of the share would be 2.18 ringgit. So moving on, for market approach, our comparable and subject company did not have the ideal performance since there were a lot of fluctuations and profits and loss from in the past 5 years. So the valuation multiple used for market approach would be price to sales ratio. The reason to use price to sales ratio is because it is less distorted, therefore more suitable to be applied in this case, as the profits for the subject company and the comparable are not consistent. So due to the high volatility of earnings and negative earnings for a subject company and comparable company, other multiples such as PE ratio, EBITDA will not be applied for this valuation because it is unable to bring a meaningful context. And as for price to book value ratio, since it is highly dependent on the capital structure of the company, we have the opinion that it is less suitable to be used in this context, as there is significant difference in capital structure from our subject company to the comparable companies. So moving on to the calculation. So just like the asset approach, we have three comparables here. So number of share of outstandings for each of the company for each of the year was obtained from their annual report. Share price from LSE for each of their financial year. So the market cap is the result of multiplying number of shares outstanding with their share price, and the revenue sales were also derived from their annual report of each of the companies. The PS ratio is by dividing market cap with the revenue and sales. So that has been done for each of the comparable companies. And we took the median of PS ratio as the multiple, which is 0.87. So coming to a subject company, we got the sales for our subject company for the past 5 years from the annual report. So multiplying with our PS ratio of the industry, we got a fair market value of 1.804 billion. And the intrinsic value of Post Malaysia Berhad would be RM2.31. So next, I would like to invite New League One to explain further.
Thank you, Ashwin. So now I will be explaining of the income approach, which is the DCF method, discounted cash flow method. So the rationale of using the discounted cash flow method is based on the theory that the total value of a business is the present value of its projected future earning plus the present value of the terminal value. So the amount of projected earning and the terminal value will then discounted to the present using an appropriate discounted rate. So as you can see here, we have obtained the data for the operating cash flow from the cash flow statement for each company throughout the year from 2015 to 2019. And then later on, we will use the compound annual growth rate to calculate the rate of return of the company in terms of its operation over a certain period of time, like I said, from 2015 to 2019. So as you can see, the operating cash flow for our comparable one is 5.42%, while our comparable to Tiong-Nam is 25.49%, and the last comparable, the nationwide, is 32.44%. So after we have obtained the growth rate for each company, we will choose the median growth rate, which is from the Tiong-Nam one, which stays in the middle one, 25.49%. And then as for the weighted average cost of capital, it stands for meaning context, which is known as the minimum return required by the company. So this percentage, we will use it later on during the discounted parts. And then the risk-free rate is then we obtain from the Bank Negara Malaysia. Moving on next to the core calculation parts. Okay, so as you can see, we have obtained the operating cash flow from our post-Malaysia groups from 2019 balance sheet, and as you can see, it stands for 103 million around. And then after that, we will use a growth rate we calculate from the industry median to calculate the each next year of the expected operating cash flow. And then what to mention is during the year 6, you can see there's a terminal value here, the terminology here. Like Afi have explained in the very beginning, the premises of a value is based on a going concern. Since the DCF method is to calculate the future value and then discounted to the present value for indefinite time, and by assuming the business is going concern principle, so the terminal value is then calculated using the formula, and then we will discount all the expected operating cash flow to its present value using the WACC rate. As you can see, once we add up all the firm value, we have obtained around 66 billion of ringgit Malaysia, and then we will subtract out from the total liability obtained from the balance sheet. As you can see, the fair market value will stand for around 5.05 billion, and the intrinsic value after dividing the number of share outstanding, it will give us a value of 6.46 ringgit Malaysia. Moving on next, after the discussion just now by Afiq and I will go into the summary of operations. So as you can see, our market value of our post Malaysia stand for ringgit Malaysia per share. This is a market value we have obtained from the Bursa Malaysia as well as from the Post Malaysia East. And then throughout the recalculation, the market approach, asset approach, and income approach, they also same outcome, which is indicating that the current market value of our subject company is currently undervalued because the intrinsic value is higher than their market value. So I will further explain that during our at our final conclusion, we thought of the market approach and income approach is not suitable is because of, even though our market approach, we have chosen the comparable which is similar in nature to compare to our subject company. However, the core business and then the aspect that focus on is different from each one to another one, which means that the method we use, the PS ratio to calculate to compare to each other, cannot stand a strong context and cannot stand as a strong evidence to support the value we ascertain is same as is exactly the value of our subject company. And then as for the income approach, like Ming Yao said during her financial analysis throughout the year and compared to industry, you can see that the performance of the Post Malaysia is actually not stable and not performing well in the past few years, and even have a negative earning just for 2019. And that is the reason why we say that income approach is not suitable, because the result outcome is not reliable. So we will choose an asset approach as our best approaches, and then we will arrive our value, fair market value, as 1,706,000,000 ringgit Malaysia for our subject company, Post Malaysia. And that's all from us. Thank you.
Okay, thank you. Group number 5. Okay, any question from the floor, from the students?
I have a few questions here. First, your analysis too. When you do your analysis, you cannot present the financial year as 2015 to 2017, 2017 to 2017, because normally when we do the analysis based on the financial year, so you cannot present like this. So normally the financial year will be, let's say, 31st March 2016, 31st March 2017. It is not the way that you should present your data lah. And then this is common size analysis, right? So
Yes.
actually for this is income statement common size analysis, right?
Consists of both, which is the balance sheet as well as the income. The first part is the income one, the second part is the balance sheet.
For incomes, for common size income statement analysis, where do you get the percentage from? How you derive with the percentage?
Okay, so the data is obtained from the financial report from 2015 and 2000.
How you derive the percentage? I'm not interested in your data. How you calculated the percentage? How do you get percentage for gross profit, percentage for operating expenses? What is the
So
basis?
How you calculate?
Yes, I obtained the data from the annual report, and then I divided the gross amount of gross profit with the revenue, and then so as the operating expenses and the profit.
Okay.
Operating profit as well.
Okay. How about balance sheet common size analysis? How do you calculate the percentage?
Okay, for the percentage for the total asset, for the asset here, I divided the amount here with the amount of total asset. Therefore, I will obtain the percentage for rest of
Okay. When I say okay, no need to explain further lah. Just to cut short the next thing is your comparison. If you look at the nature of your, I would say that you are comparing apple to orange, not apple to apple. do you all aware that in doing a business valuation, it has to be based on due diligence? Do you understand what does due diligence mean?
Oh,
What is due diligence?
it's an effort taken to reduce mistakes.
But when you shows your comparison, it doesn't convince us that you are doing your job with regards to due diligence. Because if you look at the Tiong Nam Logistic, it is totally different as compared to Post Malaysia, because Tiong Nam is concentrating on warehousing logistic, the shipping container punya business. It's not like Post Malaysia ni a mix between So lagi satu JDEX ni is an international company, because it is compare a national punya company dengan international. Of course, if you look at the criteria that you compare to, if you look at the market capitalization, it's huge difference between JDEX dengan nationwide. But JNT ke, which is more local based company when you are comparing Post Malaysia, because when you are doing your job, business relation like this, it shows that you are not doing your job with regards to due diligence. Because sometimes they call it due professional care. You are not doing it professionally, because you are exposing yourself to be because you are not particular, you are not concerned about the comparison that you choose to. And then the rate for industry rate that you shows in your analysis, is it a rate for main competitors or the average industry rate?
The rate shows the median for the comparables.
Medians? But
Yes,
you shows that, but you stated there is average, is industry.
we use median to eliminate the outliers. Because
Is it median for industry or is it median of your comparables? It is two different things. Median for your comparables is median between the three companies that you choose as your comparison. But if medians for the industry, meaning that medians from, let's say you have 200-300 companies within the same industry, it is totally different. So that's why I highlight the due diligence concept too. It shows that you are not doing your job in line with due diligence punya concept. Yang lain-lain tu saya simpan je lah komen tu. I can spot a lot of mistake lah, but let's give opportunity to you, to your other classmate to give opinions or to ask questions with regard to your business relation ni.
Doctor, just wondering, in the case like you say the comparable, we are not choosing the best one, because we know that Post Malaysia is a public listed company inside the Perusahaan Malaysia, and then we check through under the transportation and logistics segment. Actually, most of the other company are actually under the harbor one, which is they are doing the port clearing activity, and then this is the reason why we choose these three company. But if surveyor say, so we need to choose the not listed one, because like just now you mentioned the JNT. Is it applicable if we choose that? Because they will be different, right?
No, when we are doing whatever valuation, you have to do it with the concept of due diligence. When choosing the comparables, you need to be careful to choose the company as close as possible to your subject company. Kan?
Yes,
so
yes.
and then when you presenting your analysis whatsoever, you did not mention as whether you are taking into consideration the impact of COVID-19 to your performance or not.
Oh, okay.
It is okay. It is okay if you are taking into consideration or not, but you need to spell out, this relation is not taken into consideration the impact of COVID-19 to the performance of our company. It is as a safe statement lah on your side as a professional who are doing the business relation for that particular company. Because if you look at the real situation out there at the moment, most of the businesses are affected by the COVID-19. So by right, you should clearly mention in your report somewhere, or when you are doing your presentation report, you should clearly mention whether or not you take into consideration the impact of COVID-19. Because if you look at the nature of the company, the number of outstanding shares, that's more than 5 billion, whereas for Yongnam and Nationwide is 460 million, 220 million. So in terms of size pun dah macam, kalau kita ibaratkan macam you do real estate valuation, you are comparing single story terrace with a bungalow. That is the perumpamaan dia. Gedak is a bungalow, Nationwide is single story terrace, Yongnam is double story terrace. Is it comparable? That's why I mentioned on Monday, when you do the comparison method or approach, you have to go back to the basic principles of doing comparison method. You tak compare, you cannot compare Min Yao dengan Ashwin, totally different dari segi gender, dari segi physical, dari segi even though the age is maybe the same. Macam itulah. So okay lah, no more question from me.
Okay, no question from me. By the way, I think you have done a good effort. Okay, so we move to group number 2, number 6. Yeah.
Thank you, sir. Thank you, sir.
Thank you, doctor. Thank you, sir.
Thank you.
Thank you.
Thank you, sir.
Oh my God. Okay. Good morning to Dr. Surveyor Zahira binti Yahya and Sheikh Zulkifli bin Aisha. We are from SDY Properties in Dira Berhad to do a valuation of YIPCA and MSC Berhad. Before we start, I would like to introduce ourselves. Our group members include Cheng Huimin, Shiliu Pepe, Setiwan Wida, Liu Kaiyun, and me, Li Wenyue. Next slide. Moving on to the background, YIPCA and MSC Berhad is a business software solution company specializing in the property industry for 33 years. YIPCA and MSC Berhad is a public listed company on the Bursa Malaysia. YIPCA and MSC Berhad also provides technology domain expertise for their clients. Next. This is about the board of directors of YIPCA and MSC Berhad. Basically, there is one executive chairman, one deputy chairman, and 4 directors. Next. This is the core business of our subject company, developing products and services that will transform entire property value chain. For the last 30 years, they have built a large and strong consumer base, gained in-depth industry knowledge and expertise, and developed proven and comprehensive applications of various solutions. YIPCA is reinventing and investing to spearhead the property technology to develop solutions and services, which are contract services 5, property services 5, lease services 5, hotel services 5, HR services 5, and the BI services 5. Next. The financial year is in 31st December 2019. Next. For the purpose of valuation, we SDY Properties in Dira Berhad were appointed by YIPCA and MSC Berhad to ascertain the fair market value of subject company
as an ongoing concern for sale purpose. Next. The comparable companies chosen in the same industry, which is the technology industry, named the Willow Glen MSC Berhad, Excel Force MSC Berhad, and OpenSys Berhad. Next. The table shows that the main business is software for both subject company and the comparable company, as the products for their company is shown above, and the rest will be further explained in the valuation approach. That's all for me. Now I would like to invite Shirley.
Thank you, Wen-Yuan. Now I will proceed to the business common size financial statement. To do this vertical analysis, we extract the figures from cash flow statement in annual report. Common size financial statement of IFCA has been compared to 3 comparable companies in the same industry from past 5 years, which is from 2015 to 2019. Vertical analysis helps us to understand the correlation between the single item on a balance sheet and expressed in a percentage. This graph shows the comparison of some item on the balance sheet between our subject property and the industry. On the graph, subject property has poor performance and net income. For the total liability of the company is lower than the industry, whereas the total equity is higher than the industry. Next, I will proceed with the financial ratio. In terms of liquidity ratio, we take current ratio and asset test ratio. The current ratio of IFCA is lower than the industry. This indicates that IFCA has a higher risk of defaults. Besides, the asset test ratio of IFCA is lower than the industry. This shows that IFCA is not efficient in covering its liability through the cash and account receivables in the industry. I have involved 5 analyses in profitability ratio. For instance, the first one, net profit margin of IFCA is lower than the industry. This shows that IFCA is unable to effectively control its costs and provide good or service at a price significantly higher than its cost. Another example is the last item, return on investment capital. The return on investment capital of such a company is higher than the industry. This indicates that the such a company could generate more return on invested capital than the industry. In efficiency ratio, there is an asset turnover ratio and equity turnover ratio. The asset turnover ratio of IFCA is lower than the industry. It means that IFCA are unable to utilize the industry to the debt to equity ratio of IFCA is also lower than the industry. So IFCA is getting less of its financing by borrowing money. That's all for me. Then I will pass to Vida to present the asset approach.
Thank you, Shirley. So I will proceed this presentation with asset approach, which are used to determine fair market value of the company. The analysis of normalization include 2 components, which are trade receivable and cash and bank balance. Next. The 5-year historical financial statement of subject company and boasts 3 comparables chosen from the same industry, which are Willow Glen, Excel Force, and OpenSys. The normalized trade receivable were obtained by dividing trade receivable to the revenue of the companies. Both company and comparable will be deducted to get adjusted percentage of 6.50%. Next. The normalized cash and bank balance will be obtained by dividing cash to current liabilities. Both comparable and company median will be deducted to obtain normalized percentage, which is 14.56%. Next. Both 2 components will be adjusted in audited balance sheets of IFCA and MSC Berhad to get normalized value of asset. Next. Shareholder capital also has been adjusted to 86%. Next. The revised net asset value obtained is 125 million, while NOSO, which is the number of shares outstanding, is 608 million. RNAV per share or intrinsic value of the company are obtained by dividing RNAV to NOSO, which is 21 cents. The RNAV per share, which is 21 cents, is lower than the current market price, which is 49 cents. The share price of the subject company is overvalued. Hence, the investor shouldn't buy it from the market. Next, I will hand over this presentation to Chong Hui Min.
Okay, thank you, Vida. Now I would like to present the income approach of our subject company. Valuing a company based on the amount of income the company is expected to generate in the future. We are using discounted cash flow method to value for our company. So next, we use the EBITDA, which is based on the past 5-year annual report from 2015 to 2019 to calculate for the growth rate for 3 comparable company and also for our subject company. Hence, we will get 7.68% as the average growth rate for industry and also subject company. Next, moving forward to the DCF valuation model, we are projected 6 years in this approach. The use is 10.5%, which used to calculate the present value. So for the DCF, EBITDA, we calculate by using the growth rate, which is 7.68% that we calculate previously. Then we use the present value formula to calculate the total amount for each year. Then, at the point that arrive 2035, we're using the formula to calculate for the terminal value. After that, we total up the EBITDA and also the terminal value. Then we will PV the total value and get the present value of the total value. So, for the firm value, we sum up from 2019 to 2035, and we will get 234 million as our firm value. Hence, for the intrinsic value, we divided the equity value, and we use the equity value divided by the number of outstanding, and we will arrive 3 as our intrinsic value. So, in conclusion, intrinsic value for our subject company is lower than the market share price, which the intrinsic value is 33 cents and the market share price is 49 cents. Hence, the share price for our subject company is over. Next, I would like to pass to Kayun to present about the market approach.
Thank you, Hui Ming. So the idea to use the market approach is to compare business to similar businesses that have actually sold. So we will start with our comparable one, Willow Glen MSC Berhad. So most of the information can be extracted from annual report of their companies, and some information need to refer through the online on Bursa Malaysia. So the first one, price to earning ratio, P to E ratio. Normally the investor use P to E ratios to determine the relative values of a company's shares in an apples to apples comparison. So the formulas of P to E ratio is equal to market value per share divided by the earning per share. But in order to get the EPS, earning per share, we need to use the net income divided by number of outstanding shares also. So we proceed to the second ratio, price to sales ratio. So P to S ratio is a valuation ratio that compares a company's stock price to its revenue. So the formula we use is equal to market capitalization divided by revenue. So we proceed to the third one, enterprise value to EBITDA ratio. So I will discuss about the EBITDA first, earning before interest, taxes, depreciation, and amortization. So EBITDA is a measure of a company's overall financial performance. So the formula to arrive at the EBITDA we use is net income plus the interest plus taxes plus depreciation plus the amortization. But in my case, we use the easier method, which we directly use the operating profit by adding the depreciation expenses and amortization expenses for the easier case. So we proceed to the enterprise value. Enterprise value is a measure of the company's total value, and the formula to arrive the enterprise value is equal to debt plus the market value equity plus the preferred share, deduct cash, deduct the net operating asset. So finally, we will come up with the EV to EBITDA ratio for this case. So we also apply the same ways for the valuation multiples on comparable 2 and the comparable 3. After that, we median the value of these three comparables to arrive at our industry median. So we assume that these three similar comparables can actually be the industry median in our case. So we proceed to the subject company. So we also have to calculate the price to earning ratio, the price to sales ratio, and the EV to EBITDA ratio in our subject company. So we calculate the P to E ratio by using the median of net income of our subject company multiplied by the P to E ratio in the industry median we calculate just now. And for the second one, P to S ratio, we calculated by the medians of revenue of our subject company multiplied by the P to S ratio in the industry median we calculated just now. And for the third one, EV to EBITDA is calculated by the medians of EBITDA of our subject company multiplied by the EV to EBITDA ratio in the industry median just now. Okay, so next slide. So among the three valuation multiples, the value of the firm we taken is 100% from the P to S ratio, which is 160 million. We only adopted P to S ratio because we think that when we conducting the business, the revenues of a company is always at the top line. So in this case, P to E ratio and EV to EBITDA are not encouraged to use in our company since the earnings of our companies in the technology industry is inconsistent. Moreover, the subject company and the comparables are making losses throughout 5 years. So the P to E ratio and EV to EBITDA is omitted in this case. So in short, the intrinsic value of our subject company is 26 cents per share and is lower than the market share price. Hence, the share price of our subject company is overvalued in the market approach. So next slide. We also rely upon three methods include the market approach, income approach, and asset approach. Asset approach and market approach are not applicable in this case. In our opinion, income approach is the most suitable approach to be used. This is because income approach is based on the business ability to generate the future economic benefits and is generally suited for the profitable business. As for IFCA MSC Berhad, they generate the income through the sales of its own software products. Besides, income approach focus on the actual company being valued, not referring to other firms or not referring to assets of assets. So next slide. Taking into the considerations of all the vitals and relevant factors, we are of the opinion that the fair market value is 234 million. I think that's all from us. Thank you.
Okay, Surveyor Zul.
First thing is you cannot round up when you are doing business relation, because I already commented in the last section, you cannot round up the because when we are doing a business relation, we are advising the clients on the reasonable value of the business. So at the end of the transaction, it is up to the seller and buyer to negotiate what is the final price to be paid based on our professional advice. So you are not doing like a real estate or properties valuation whereby we used to round out the value, the final value that we put in the report. Other than that, I think most of the group are repeating the same mistake. I'm not going to comment every time of when every group is presenting. So basically, it is a good try, a good effort, even though you just learn a basic on business relation. Well done.
Okay, good. We move on to group number 7, yeah? Group number 7.
Thank you, Doctor. Thank you, Sazu.
Okay, thank you. Good effort, yeah? Actually, I'm quite impressed with all your presentation, yeah? I take into consideration all the barriers, yeah? Mungkin you tak dapat information. Okay, group number 7. Okay.
Hello, Doktor. Boleh start ke?
Boleh. You may start now.
Assalamualaikum warahmatullahi wabarakatuh. Good morning to Dr. Surveyor Zahiria and Surveyor Zulkifli. Today we would like to present about my business valuation of Rahir Utilities Sdn Bhd. We are from MK Sdn Bhd. Before I start my presentation, I will introduce my group members. Lai Sotli, Nurul Ain'ni binti Kamarul Zaman, and Yu Mingkai, and me, Nur Wahida binti Muhammad Suhaiji. Next. We were appointed by Rahir Utilities Sdn Bhd, which is Datuk Sri Lim Ho Kwang, Executive Director of Rahir Utilities Sdn Bhd, to assess the fair market value for sale purpose. The date of valuation is on 30 November 2020. Next, I will pass to Lai Sotli.
Thank you, Wahida. Now I will continue with company background. Rahir Utilities Bhd is an investment holding company which engages in provision of management service. It operates through the following segments such as environment, power, and others. The environment segment offers water supply service, operate water and wastewater treatment plants, and provide service in the management and optimization of water utility assets. The power segment owns and operates combined cycle gas turbine power plants in Sabah. The other segment consists of investment holding and provision of management services to subsidiary within the group. Its operation and services are primarily in Malaysia and its international operations are centered in ASEAN markets such as China, Thailand, and Southeast Asia. The company was founded on April 28, 2014 and is headquartered in Kuala Lumpur, Malaysia. Next is stock classes and ownership. The total number of issue are 1,072,936,566, and the voting right is 1 vote per ordinary share. Next is the product and service information of Rahir, which are environment and power. For environment, Rahir conduct its environment business through Rahir Syarikat Air Johor, Rahir Water Services Sdn Bhd, and Rahir Water Technology Chairman, which were all part of Rahir Utilities Sdn Bhd. The incorporation of Rahir Utilities Bhd was primarily to facilitate Syarikat Air Johor Holdings listing on the main board of Kuala Lumpur Stock Exchange. Syarikat Air Johor Holding was formed to carry out the water supply services in Johor for 30 years, commencing from 1 March 2000. The water supply services business in Johor was subsequently privatized to Syarikat Air Johor Holding as part of the state government of Johor effort to further improve the operation and service level of water supply in Johor. Next. For power, Rahir conducts its power business through Rahir Powertron Sdn Bhd, Rahir Powertron True Sdn Bhd, Rahir Power O&M Sdn Bhd, and Rahir Power Service Sdn Bhd, which were all part of Rahir Group Sdn Bhd. Rahir Group Sdn Bhd was incorporated in Malaysia under the Act in June 1972 as private limited company under the name of EPE Power Corporation Bhd. Through its 60% owned subsidiary Rahir Powertron Sdn Bhd, Rahir Group Sdn Bhd operates a 120 MW electricity capacity open cycle gas turbine power plant at Telur Salu, Kota Kinabalu, Sabah, pursuant to power purchase agreement dated February 1997, entered with Lembaga Electric Sabah, which now known as Sabah Electricity. Next, market analysis. According to Tinjauan Economy 2020, the value of gross output generated by the economy increased from 1.6 trillion ringgit Malaysia in 2005 to 2.1 trillion ringgit Malaysia in 2010 and further to 2.8 trillion ringgit Malaysia in 2015 with growth 5.3% and 5.9% respectively. Compound annual growth rate of utilities from year 2005 to 2010 was 6.1% and it increased to 6.5% from year 2010 to year 2015. Next. There are 3 comparable companies which are Kumpulan Berangsang Selangor Berhad, Malakoff PBA Holding Berhad, and Malakoff Corporation Berhad. First is a Kumpulan Berangsang Selangor Berhad is an investment holding company which engage in the provision of management service. It operates through the following business segment included investment holding, infrastructure, manufacturing, licensing, trading, oil and gas, and property investment. Under trading, they have Aqua Flow Sdn Bhd, which supplies water, chemicals, and provide technical service to water, waste, and sewage treatment plants. Next is PBA Holding Berhad. Is an investment holding company which engage in the water supply business. Its principal activity include abstraction of raw water, treatment of water, supply and sale of treated water to customers. Last is the Malakoff Corporation Berhad. Is an investment holding company which engage in the provision of water and power. It specializes in power generation, water desalination, and operation and maintenance services. It operates through the local and foreign segments. Now I will pass to Yu Ming Kai.
Okay, thank you, Soling. So I will be continue on the Malaysia economic in the fourth quarter of 2019. So as you can see, the gross domestic product, which is GDP of Malaysia, grew 3.6% from 4.4% in the previous quarter. Overall, in year 2019, Malaysia economy registered a growth of 4.3%, which is compared to 2018 with 4.6%. So consumer price index CPI in the fourth quarter of 2019 recorded an increase of 1.0% as compared to 1.3% in the third quarter of 2019. The producer price index for local production increased 0.6% as compared to negative 2.1% in the previous quarter. Export of goods in the fourth quarter 2019 registered a decline of 3.3%. Import also decreased by 4.0%. Employed person in Malaysia increased by 2.2%. The unemployment rate in this quarter decreased to 3.2%. So actually, the economy of Malaysia recorded a positive growth throughout 2019 as it recorded trade surplus of external sector, a positive growth in GDP and CPI, which is consumer price index, and decrease in unemployment rate. So next one, I will be talking about the outlook of economy. So gross domestic product GDP is expected to grow between 6.5 and 7.5 in 2021 after a 4.5 contraction in 2020 owing to the COVID-19 pandemic. When we talk about the economic condition in 2020, we may observe that during MCO, the economy of Malaysia dropped sharply, but it actually rebounds when CMCO and RNCO. The government COVID-19 stimulus package are expected to contribute to GDP growth. So the conclusion is the country recovers from the impact of COVID-19. The domestic economy will return a more sustainable growth path. So next is where we talk about the industry condition. According to National Water Service Commission, which is SPAM, demand for water supply is growing in line with population growth and the development of the economic sector. As you can see, water consumption recorded in 2019 were 9,887 million liters per day, which is MLD lah. The unit is MLD. So which contribute by 61.1% from household and 39.9% from industrial. Annual growth rate for water consumption in Malaysia is 3.3% in 2019. There is 3 states recorded the highest water consumption, which are Selangor with 3,472 million liters per day, followed by Johor, 1,433 million liters per day, and Perak, 957 million liters per day. Actually, Ranhill is the water supplier in Johor, so we can see that the business is doing well throughout the period as demand keeps increasing. Next, we talk about the outlook of water industry. So in 2020, the market size of Malaysia water industry is estimated at RM 11.6 billion, employing roughly 40,000 people. This is the data from Malaysia Water Association. So the growth in demand drivers from both residential and industrial sectors is likely to have a positive impact on water treatment equipment industry with rising population, with an estimation of 0.4% growth of population in 2020 with 32.657 million. Last but not least, the most important thing, So in budget 2021, the Ringgit Malaysia of 332 million was put aside for water infrastructure projects in rural area. So this has shown the keenness of Malaysia government in conducting water supply to rural area that may have difficulties in supply of water. In other way, this will give a good impact into water industry as it expand the business size of the water treatment company. Then I will continue with the common size analysis. First, I will go with financial statement. So our subject company actually have more portion of profit before tax and zakat, which is under income data with 11.41% compared to industry data 8.92%. So while for total comprehensive income, Redhill has more portion compared to industry, which is 6.59% compared to 3.6%. So this has shown that Redhill are performing well compared to industry in terms of income. For asset, except property, plant and equipment, the cash, inventories and other receivable are doing good, which they are recorded a percentage of higher portion compared to the industry data. So next, I will continue with the liability. So Redhill is also doing good in terms of liability, loan and borrowing, trade and other payables. Actually, these two aspects are recorded a low portion compared to industry stated. So this means the Redhill has lower debt compared to other company in the industry. Thus, less interest need to pay to their debtor. Last but not least, actually, Redhill has more space for improvement in terms of equitization because share capital are lower compared to the industry. This is actually a good way for them to raise funds by issuing shares to the public. Anyway, at reserve, which is 22.54%, they are doing good also because they have lower portion compared to industry data. This can be more lower as reserve is surplus share that hold by the company. It can be turned into a cash generating asset or cash for business rolling. So actually, I will talk about the common size analysis for financial ratio. In terms of liquidity, Redhill's performance is for current ratio and quick ratio is below average compared to industry. Like we mentioned above, Redhill are advised to change its reserve to public shares to accumulate more cash and more liquidity. When we talk about profitability, Redhill is performing well with gross profit margin of 0.3025, return on asset, return on total asset 0.0555, and return on total equity with 0.2491, which is higher compared to industry ratio. Only net profit margin, which is 0.1141, is lower compared to the industry ratio. Redhill actually can try to reduce the cost on administrative expenses to make more net profit, since the administration is the highest portion of expenses when we go through the financial report. So the performance of Redhill compared to industry is an average for efficiency because it has relatively low inventory turnover but higher asset turnover. Despite this, it has lower property, plant and equipment ratio. This means the Redhill need to boost its sales for better turnover for the inventories. Redhill need to for leverage ratio. Redhill need to pay more attention on their debt. For leverage ratio, it recorded a high debt compared to industry with 0.7770 for debt ratio and 4.0710 for debt to equity ratio compared to industry, which recorded 0.4866 for debt ratio and 1.5643 for debt to equity ratio. They can make things right by issuing their reserve to raise cash or use the cash on hand to settle this debt. Next, I will pass to Wahida.
The valuation used to value Rahir Utilities Sdn Bhd are market approach, asset approach, and income approach. Next. For market approach, market capitalization was calculated by multiplying the market share price with number of share outstanding. The market capitalization was divided by the revenue of the company to establish PS ratio. we use the median of each data within last 5 years to get the PS ratio for each comparable. For comparable 1, we get 1.17. For comparable 2, PS ratio we get 1.53, and for comparable 3, we get 0.69. Next. So for the industry median, we choose 1.53 PS ratio for 1.53, and the median of revenue of subject company for the last 5 years was multiplied by with the industry median of PS ratio to obtain the fair market value, which is 2,765,742,065 Malaysia. And for intrinsic value is derived by dividing fair market value to number of share outstanding, which is 2.11, and market value per share price 1.07. Next, I will pass to Nur Ain'ni.
Okay.
Okay.
Is there
Continue.
any DLOC or DLOM involved in your calculation? In your calculation, does it involve DLOC and or DLOM? Discount for lack of marketability. Do you consider DLOC and or DLOM to do your calculation for your business? If yes, why do you need to take into consideration? If no, why you do not take into consideration for DLOC and DLOM? DLOC stand for discount for lack of control, because you are valuing the public limited company. It involves shares. Normally for public limited company, there will be a limited shares and shares too. So does it involve DLOC? Because if you look at
LOC, DLOM.
If you look at most of the groups who has presented, most of you are doing a public limited company, but none of you mention as whether you need to consider DLOC and or DLOM too. And then owner compensation benefits. Is there any owner compensation benefits that you need to in your company? Part of the owner compensation benefits are owner salary, retirement contribution, medical premium, life insurance premium of the owner. Because that's why some of the groups who has presented, it seems that you are overvalue the company because you do not consider or do not take into consideration all those factors which may affect the value of your holding or your company.
Okay, do you understand or not what surveyors do?
Yes.
Yeah. On adjustment.
Lack of marketability, I know.
Consideration the DLOC or DLOM or others. You just
because normally
why?
normally with respect to due diligence, when you are doing business relation, you need to really investigate, enjoy any benefits or compensation, because if the owner of the company enjoy any type of benefit or compensation, when you are doing your adjustment, you need to take into consideration all those benefits, compensation which is enjoyed by the owner, because it will reflect the value of the company. And then most of the group, when you are doing your analysis, you do not look into irregular income reported in the company's financial statement. For instance, maybe in some years the company has disposed any of its asset. So maybe when the company disposed any of its asset during that particular year, the income reported for that particular year will be a bit higher compared to the other years. That's one of the main adjustment why we are doing the common size analysis on our financial statements, to look at any abnormal activities or income or asset which has been reported in our financial. So that is the basic things lah that you need to do when you are income statement for the business relation purposes. That's why when you are presenting, I just quickly browse through, scroll the information that you have presented. It's okay lah, because you are learning the basic of business relation. But for your future career, maybe in 10-15 years time, maybe you have the opportunity to do business relation. So you have to be very careful when you are doing a business relation. The key term is due diligence. Due diligence means that you have to do investigation on the companies. That's why in reality, when you are doing business relation, that's why in reality, when you are doing the business relation, after you have gathered the information from internet or whatever from the company's annual report, you still have to go on site. You still need to go to the business office. If the business have a few branches, you need to go to all branches, like you are doing inspection lah, if you are valuing a real estate or property. And then part of the process of business, the management of the company, the owner of the company, to look at if there are any abnormal activities or which will affect the value of the company. For a beginner, most of you have done a good job lah. Try to fulfill the task for this assignment. But in reality, in the future, when you have the opportunity to do the business, you have to be very careful. Okay.
Okay. What Surveyor Zul going to tell you is what you have to take into consideration when you value business in future. For now, I know the barriers that you are having. You cannot go on site. You cannot get all the information like benefits to the main shareholder or whatever lah. Yeah. So just bear in mind. Yeah. In future. Okay. Okay. We go to the next group. Group number 8.
Thank you, Doctor. Thank you, Sabria.
Doctor, can you hear me?
Waalaikumsalam. Okay. Loud and clear. Boleh dengar?
Okay, may I proceed?
Okay, you can proceed now.
Okay. Assalamualaikum and very good morning to Dr. Zahiria, Surveyor Zulkifli and our fellow friends. So today we are from NP Advisors in Jambuhat, consists of me, Nur Fazliana, and my group mate, Chang Chisem, Nurul Alia and Muhammad Fizuddin. We present our business valuation report of Apollo Food Holdings Berhad. Okay, next. Okay, we have been assigned by Mr. Liang Chiang Hai, Executive Chairman of Apollo Food Holdings Berhad, to assess the fair market value of Apollo Food Holdings Berhad for sale and purpose. The date of valuation is 6 November 2020 and the industry segmentation is food and beverage. Next. Apollo Food Holdings Berhad, as known as Apollo, was incorporated on 5 March 1994 and it was a public listed company in the Bursa Malaysia. And Apollo operates in two segments, which are investment holding and manufacturing, marketing and distribution. Okay, Apollo offers product in two categories, which are chocolate, wafer products and layer cake. Next. So the board of directors of Apollo consists of an executive chairman, a managing director, and 3 independent non-executive directors. Next. Next is about the product and service information. So this is the product and service. The Apollo's product mainly divide into two main categories, which is wafer products as well as layer cake. Moreover, the service of its subsidiaries are manufacturing, marketing and trading of compound chocolates, chocolate confectionery products and cakes. Next, I'll pass to my group mate to further this presentation.
Okay, thank you, Fast. Next, I will proceed to the market data analysis. For this part, we will use the SWOT analysis. The biggest strength of the Apollo is the brand equity. Apollo has been successfully to improve its brand image and the brand perception. This is because Apollo purchased the top quality materials from the reputable and the reliable supplier, and they have their unique way and unique formula to manufacture their product. Consequently, the products are favored among the school children and the adults. However, one of the major weaknesses is to deal with the raw material prices, which always fluctuated from time to time. To overcome these weaknesses, Apollo has been negotiated with better terms with the suppliers. Then the related department also monitor the prices of the raw material and make sure that the raw material are not compromised in line with the lower purchase price. Next, I will talk about the opportunity. The diversification means expansion through the new product line and create infinite opportunity. It will provide the opportunity to Apollo and minimize the risk in encounter and increasing the profitability. Last but not least, intense competition in the industry is one of the key threats that Apollo will encounter. This is because food and beverage company often give rise to competition due to the reason high and volatile commodity price. And the food and beverage market are growing very slowly, and with so many startups, Apollo will find it hard to compete in the future. Next, I will briefly talk about some business risks that will faced by Apollo, which is our subject property. First, Apollo is currently facing a business risk of fluctuation of raw material prices. It is one of the major businesses that Apollo will face. How to overcome? Apollo will negotiate the better term with the supplier, and the related department should monitor the price from time to time to ensure that the quality of raw material does not going down with the lower purchase prices. Then, one of the businesses is also the fluctuation of the foreign currency exchange rate. Generally, a weaker currency makes the import expensive and stimulate the export, while a strong currency makes the import cheaper and reduce the export. Since this will significantly bring the effect on the profitability of Apollo, the management team of Apollo should monitor the foreign currency exchange rate from time to time. Next, one of the businesses is also the customers' preference will be changed from time to time. This is because in this new era, consumers tend to consume the healthy food as compared to the olden days. Apollo is aware of the shift of the customers' preferences and understand that the consumer nowadays prefer to consume the less sugar food and the sweetness food. And then I will pass to Alia, pass to Faz to explain the next slide.
Okay, thank you, Sam. So I will continue with the comparable company. This is our comparable company: Spritzer Berhad, Cocoland Holdings Berhad, and MSM Holding Berhad. Next. Okay, common size analysis for Apollo Holdings Berhad. Okay, common size analysis segment is from most recent historic year as we compared on a normalized basis. So the source of the data is from the company's annual report. For cost of sales, the percentage is decreased from 2015 until 2016. Then in 2017 it increased, but it decreased again in 2018 and 2019, which is resulted to fluctuating value in gross profit margin. Okay, next. This is the common size analysis between business and industry common size analysis. This is the Apollo common size financial segment is be compared to 3 comparable companies in the same industry. For cost of sale as a percent of net sale, which more than the industry, resulting to of Apollo is more than industry percentage, which is resulting to the much lower gross margin profit for Apollo. Receivable percentage of Apollo is higher than the median of industry, which is because of the total asset for Apollo is higher than comparables. Next, financial ratio analysis. First ratio is the liquidity ratio. Liquidity ratio is to measure the ability of a company to meet its short-term obligation. Current ratio and quick ratio is used to calculate under liquidity ratio. Current ratio helps investors and creditors understand the liquidity of a company and how easily the company will be able to pay off its current liability. Quick ratio is to measure the liquidity of a company by showing its ability to pay off its current liability with current asset. Profitability ratio measures the firm's ability to earn an adequate return. Efficiency ratio is used to analyze how well a company uses its assets and ability internally. And lastly is the leverage ratio. Leverage ratio shows how much capital comes in form of debt or assesses the ability of a company to meet its financial obligation. Leverage ratio can be calculated using debt ratio and debt to equity ratio. Okay, next. Okay, as you can see, the liquidity ratio between industry and Apollo. The current ratio of Apollo is 15.05 times higher than median of industry. This means that Apollo can meet short-term obligation of 15.05 times against RM1 liability. Quick ratio of Apollo is 5.90 times, while quick ratio for median comparables is 2.14 times, which means RM1 Apollo current liability, company has RM5.90 of liquid assets to cover those immediate obligation. So gross profit margin for Apollo Holdings is higher than median, is lower than median industry. Low gross profit margin indicates that the business is unable to control its production costs. Next is the debt ratio. Debt ratio for Apollo is higher than comparables, which means that RM1 of Apollo asset, that the company has 0.08 debt. Next, I'll pass the presentation to my group mate.
Okay, thank you, Alia. Next, I will explain the market approach in the next slide. Okay, as I earlier mentioned, we have adopted the three comparable company, which is the Sprinzer Berhad, Cocoland, and the MSM. For market approach, we need to calculate three price multiple, which is price to earning ratio, PE ratio, price to sales ratio, also known as PS ratio, and the enterprise value divided by EBITDA, which is also known as the EV/EBITDA ratio. Okay, next I will briefly explain how to get the ratio. The PE ratio we calculate is based on the formula, which is the market price per share divided by the earning per share. And all of this data we also is extracted from the annual report. And then we calculate the median of the price to PE ratio. And next, PS ratio is calculated by dividing the market cap by the revenue. And we get the PS ratio. And the enterprise value, it is calculated by the formula. The market value of equity plus the preferred share plus the total liability plus the minority interest, and then minus the cash and cash equivalent, and we finally get the enterprise value. And for the EV/EBITDA ratio, we divided the EV by the EBITDA, and we get this ratio. And after that, we also adopted this method in the two comparables, which is the Cocoland and the MSM. And then finally, we get the summary of the comparable median, which is the PE ratio at 15.12, PS ratio at 1.4, EV/EBITDA ratio at 10.20. After that, we calculate the fair market value for each of the ratio respectively. And for this PE ratio, we calculate the median of the net income for Apollo and multiply by this, and we get the fair market value. And for the PS ratio, we get the median of the revenue for Apollo and multiply by the PS ratio, and we also get the fair market value on this. And finally, we use the median of EBITDA and multiply by the EV/EBITDA ratio, which is 10.2, and we get the final market value, fair market value on this. And then we apply the rule of thumb on these three price multiple, which is 50% for the PS ratio, 30% for the EV/EBITDA ratio, and the 20% for the PE ratio. And in conclusion, that the total final fair market value by using the market approach is 360,943,159 ringgit Malaysian. Next, I will pass the presentation to Faz.
Okay, now I will explain more about the income approach. The income approach quantifies the present value of anticipated future income generated by a business or an asset. So forecast of future income require analysis of variable that influence income, such as revenue, expenses, and taxes. So there are three methods in income approach, which is capitalization of earning method, DCF method, and assess earning method. So for Apollo, we choose DCF method in order to get the firm value. And moreover, we use DCF to know the present value of each projected future earning and the cash flow the business is expected to produce in the future. So first, we have measured the industry growth by observing three comparable, which is Sprinzer, Cocoland, MSM Malaysia. So from the three comparable, we get the total industry median growth per annum is 0.18%. However, the growth of subject company also needed to be considered for this valuation. So currently, the growth of subject company are not stable and result negative 0.05%. So we have taken the growth of industry together with the growth of the company and come up with 0.07% of growth rate for this method. So this is the assumption before proceed with DCF, where the WACC, where the beta is 0.67, WACC 8.50%, obtained from the reliable website, and risk-free rate is 2.63% from Panadol Malaysia. So next. So this First, we value the company using free cash flow, and also we forecast for 6 years. And at year 6, we have the terminal value, and in year 2020 onwards, we have applied the present value to the free cash flow using the WACC as the discount rate. So finally, we total the value to reach the firm value, which around RM714 million. And after that, in order to get the increased value, we divide the firm value with NOSO and get the increased value of RM 8.67 cents. So next, I pass to Hafizuddin to further our presentation.
Thank you, Fazliana. Okay, next. Now we move to asset approach that use adjusted net asset value method. As you can see on the slide, after we divided account receivable and sale from 2015 to 2019, for comparable one is 20%, for cash divided by current liabilities is 31%, and inventory divided by sales is 12%. For comparable 2 and 3, we use the same technique. Next. For subject company, median 3 comparable for 5 years is 19% for account receivable, 31% for cash, and 40% for inventory. For Apollo Food Holdings Berhad, which is our subject company, the percentage for account receivable is 70%, for cash is 1000%, and for inventory is 6.4%. The adjusted percentage we get when the median 3 comparable for 5 years subject company, deduct the median 3 comparable 5 years, deduct the median 5 years of subject company, we get the adjusted 2%. For account receivable, for cash we get negative 969%, for inventory we get 6.4%. Next, we move to balance sheet. Okay. The total asset for audited is around 148 million. For we do adjustment for cash, which is 969%, and then we get the adjustment which is around 1 billion, and then we get the normalized 869 million. For account receivable, we get around 29 million. For inventory audited, we get 15 million, and then the adjusted for cash, we get 969. For account receivable, 2%, inventory 6.4%, and then plant equipment 10%. For investment properties 20%. Then for normalized, we get total current asset, which is 851 million. For total non-current asset, we get 101 million. Then for revised net asset value, we get from the total asset minus the total liabilities, which is we get 759 million. So for the fair market value, we get around 759 million. Next. As you can see on the slide, this is the summary of fair market value for each approach. Market approach is around RM 260 million. Income approach is around 715 million. Asset is around 755 million. Next. As Apollo is an income producing company, we had chosen the fair market value, which is 740,830,963. The income approach quantifies the present value of anticipated future income of the company. By using DCF, we can project the future earnings of the company and back to our purpose valuation, which is sale purpose. To conclude the fair market value, we can say is RM 71,500,000. That's all from us. Thank you.
Chisam, what is the price of the share now? Price of the share.
You mean Apollo for comparable?
Apollo.
Earning per share, right? Price per share. Okay.
Per share price. Market price.
Show in the Excel.
RM3.88.
Mana boleh orang tanya you jawab show in the Excel. You answer lah. That is not the way you answer question when you do presentation. Cisa, Mayo.
Zul, I dah detik in mind nak tolak markah presentation dia. Buat macam tu.
Sorry.
Very good. Like that. Just imagine if you are doing a corporate presentation, definitely you will not get the project. Okay, out of the three comparison,
compare intrinsic value with the market price per share. Is it overvalue or undervalue?
All of these approach of total two approach, right? All of these are also undervalued for the compared to the market value.
Why didn't you letak dalam your presentation? Yang tu yang penting, yang tu yang apabila orang nak jual ke, orang nak beli ke, dia nak tahu ya harga share sekarang melebihi atau lagi kurang daripada the intrinsic value. Ya, patut compare. You patut letak in every slide of the three approaches. Ya?
You have listed a few type of risk which is associated with the business. Have you explained somewhere how to mitigate the business risk? Because as far as a business relation is concerned, the risk will also has influence on the value of the company. How do you mitigate the risk?
For the raw material price, this risk I think Apollo can negotiate the longer term with the supplier and
answer professionally lah. We don't trust what do you think. You need to answer based on the data that you gathered from the market, based on study that you have done in order to value this company. Try to answer professionally.
Okay. First thing, Apollo must negotiate with better term with the supplier, and the management team should monitor, but the management team of Apollo must monitor the raw material price from time to time. If the raw material prices will be higher in the future, then the Apollo should buy from at the time from now. For the foreign currency exchange rate, this risk must also encountered by Apollo, and the related department should monitor the foreign current exchange rate, so that when there is a weaker currency exchange rate, because generally a weaker currency exchange rate will reduce the import and stimulate the export. And for this time,
okay. Because normally this is one of the things that you need to highlight in your report and when you are doing your presentation. Because business risk, different type of industry will have a different exposure to the risk. So that's why when you are doing your business relation, you need to highlight. And then one more thing about your comparison. From the three comparison, I would say that Cocoland is the most appropriate comparison as compared to Apollo. The other ones, Fraser and MSM, is not a comparison. If possible, you need to find any better comparison, because even though in general their business is in the food industry's business, but SM is more on sugar punya manufacturing. Fraser is more on mineral water products punya. It's not like multiple product like Apollo and Cocoland. Apollo is more on macam lebih kepada biscuit junk food punya. So in terms of if you look at into details, the type of business so is a bit apa ni lah, people can argue. So
means that although we are valuing the food and beverage company, once we take the food company like Apollo, we cannot compare with the food. We cannot compare it with the beverage company, right?
As I keep repeating from last on Monday, the basic principles of a comparison kan, if you are using comparison ni, you need to find as close as possible so that we can avoid from having to do a big adjustment, because if you have to do a major adjustment, it is afraid that your figure tu nanti will be lebih tak tepat lah. Lagi satu EV to EBITDA. How do you decide? Let's say on your screen just now, you show one of the company, the EV EBITDA is 10.20. So what is the rule of thumb on EV EBITDA?
20.
30%.
30%.
30.
The general rule of thumb is if the company has EV EBITDA is 10 or less, meaning that the company is in a good position. Normally, most of the investors or buyers will look at the company's EV EBITDA ni 10 or less than 10. 10 is the ceiling lah, the highest. If the EV EBITDA is more than 10, normally investors or buyers are not interested in that company. So when you are doing those analysis, you need to understand what is the reason behind. Like let's say the EV EBITDA, what is the rule of thumb? More than 10, normally investors will not choose the company. If 10 or below, meaning that the company is in a good condition, so the investors or potential buyer normally will invest in that particular company. So you need to know. Not just do the calculation EV EBITDA without knowing what is the reason behind.
Noted.
Okay lah, I have no more question. Okay, we move to the last.
Thank you, Professor and Doctor.
Okay. Hi. Good morning to Dr. Zo and Dr. Zai. All right. We are group consider number 9. All right. And then today we are going to present about, let me show the slides first. You guys can see, right, Doctor?
Yeah.
Can all right. Okay. So today we are presenting the group for Sunway REIT Management Sdn Bhd. We are from Normally Sdn Bhd. And then I'm today with my members, Nazri, Izzat, and also Melissa. We're going to present this Sunway REIT Management Sdn Bhd annual report, right, valuation report. So first, I'll pass to Melissa.
Okay, thank you, Chua. Now I will continue on with the presentation. So these are the purpose of valuation, date of valuation, and the limiting conditions imposed for our valuation. Next slide. Next. So these are the mission and vision for our subject company, Sunway REITs. Next slide. A brief description on our subject company. It is one of the largest diversified REITs company in Malaysia and was listed in Bursa Malaysia on July 2010. It has a portfolio comprising of 17 assets worth RM 8.05 billion, and most of its Most of its earnings are primarily generated by its retail assets, led by its crown jewel, Sunway Pyramid. Last but not least, their key customers are majorly stakeholders who are engaged with the company's core business. Next. So this chart shows the top 10 largest unit holders for Sunway REITs. And looking at this chart, Citigroup nominees Tempatan Sendirian Berhad holds the top with 13.3%. Next. So here are the management team. First of all are the board of directors, which is led by Tan Sri Ahmad bin Muhammad Don as the chairman. Next. Next. The audit committee led by Elvin Anak Lelaki Berti Luke Fernandez as the chairman. Next. Next. So for the nomination and remuneration committee, it is led by Tunku Nurul Azian as the chairperson. Next. The risk management committee led by Eng Sing Hua as the chairman. Next. And last but not least are the company's secretaries. Next. So the products and services offered by Sunway REITs are basically real estate investment trust and the management services. Their main objectives is to provide exposure to their unit holders to a more diversified portfolio, as well as to provide stable cash distributions. For their investment policies, about 75% of the total asset value must be invested in real estate, while the rest of the 25% will be invested in non-real estate. Next. So here it shows that the proposed DPU in financial year 2020 is 7.33 cents, which is 19% lower than in financial year 2019. This is due to the impact of COVID-19 that has affected both the hotel and retail segments. Next. The DPU has resulted in annual distribution yield of 4.5% and a total return of negative 8.9%. The average of total return for the whole 5 years is 6.5%. Next. So looking at this chart, Sunway REITs is second to EPF dividend yield amongst all of the comparative yield, with only 0.39% difference. Next. In this chart, the price for each unit in financial year 2020 was RM 1 ringgit and 62 cents, and the number of units in circulation maintained at 2.95 billion. The total market capitalization was RM 4.77 billion, which has a declining growth of 13.4% as compared to financial year 2019. Next. So here, these are the main governing regulations and guidelines that our subject company adheres to. So now I will pass this presentation to Chua.
Okay, so for my part, I will explain briefly about the national economic and industrial conditions for REITs company. And then first of all, regarding the national economic condition, we can see that through the graphs, right, charts by Department of Statistics Malaysia, right, there's a decline in almost every year from 2017 until 2020 in the economic growth itself. So we can see that in the last third quarter of the 2020, which is we have recorded a negative 17.1% of negative growth. All right, this is one of the great impact by the COVID-19 to the market. And next is to the trend. So there's a trend going downwards by the World Bank itself also, and we expect it to be around the range of -5 to 6%, all right, of the rate after 2021, okay, and then it will continue until the demand recovers back to the normal conditions. Okay, and for just a bit of extra, for the market conditions of the REITs company, basically, I mean property market, right? For all the markets like residential, retail, industrial, and commercial, right? Basically, all dropped down quite substantially due to the black swan effect. Okay, and then move to the historical financial statement. Okay, so this is the historical financial statements of Sunway REITs Management Sdn Bhd, right? From the past 5 years, financial years from 2015 until 2019, whereby we can see that actually the net income of it is quite high. And then when we look at the data compared against the median of the comparables, which are IGB REITs, Pavilion REITs, and MFirst REITs, okay, the performance of net income of Sunway REITs Management Sdn Bhd is actually considered very good compared to the industry's average or the median of comparables. But we can look at the liabilities as well because it's quite high. And when we look closer to the ratios, right, especially the current ratio, whereby the formula is current asset over current liability, then we can see that actually the current ratio of some REITs, which is significantly lower than the industry or the median average of the comparables. And it is the only distinct difference, all right, of all the ratios considered calculated against the median of comparables, which we can explain that the current ratio of some management Sdn Bhd, right, is very low and it's very hard for them to actually convert their current debt, all right, turn away, which means that their liquidity is very low, not high. I think other than that, when compared against the median average of the industry or comparables, is actually quite similar, not much difference. And lastly, part we can see the leverage ratio and the debt ratio is also significantly higher than the median of average of the comparables. So basically, we can conclude that Sunway REITs are actually quite leveraging themselves in this in their current situation, but then they actually manage quite well in terms of profits and also returns against the industry as well. Okay, so I think that's the summary of the statements here. I move to the valuation approach and now pass to Izzat.
Okay, thank you, Shaw. Now we present about the valuation approach. Next. Next slide. So for the valuation approach, the approach that will be used in this report are market approach, income approach, and asset approach. Next. The comparable companies that will be used in this report is Pavilion REITs, IGB REITs, and MFirst REITs. Next. So let's look at the market approach, which is the comparison method. Firstly, the P to E ratio, P to S ratio, and EV over EBITDA ratio that we obtain for the comparable, which is Pavilion REITs, IGB REITs, and MFirst REITs are 19.0, 17.80, 23.15, 18.16, 11.65, 4.62, 21.28, 90.56, and 20.01. Next. So as for the comparable medians, for PE ratio is 19.90, PS ratio is 10.16, and EPO EBITDA ratio is 20.81. So this will come to fair market value of 8.448 billion for PE ratio and 5.3 billion for P to S ratio and 7.5 billion for EV over EBITDA ratio. Hello.
Yeah, we can hear you.
Okay, so for the right, okay. So for the income approach, the DCF method we will use for the income approach. So the average growth rate that we obtain by using the subject company and the comparables are 4.69%, and then we will use the data of data 1.05, WACC of the ACC 5.40%, and initial cash flow to 399 million, and long-term growth rate of 1.75%. Then next. Next. Hello, hello.
Nazri? Yeah.
Next slide.
DCF, sure.
The slide tak nampak. Okay, tak apa. So for this method, yeah, sorry. So for the fair value that obtained for DCF method, the fair value we obtain is 13.3 billion, and then will be divided by deduct by that value to obtain the equity value of 10 billion, and then will be divided with also to obtain the intrinsic value of 3.4 ringgit, which then is bigger than market value, so that the market value is undervalued. So next I will pass to Nazri for further explanation. Thank you.
Next. Thank you, Izzat. Now we move to asset approach that use the adjusted net asset value method. As you can see on the slide, after we divided account receivable and sales from 2015 to 2019, for comparable 1 is 9.82%, comparable 2 is 4.99%, and comparable 3 is 9.09%. While for cash divided current liabilities, comparable 1 is 179.04%, comparable 2 is 99.2%, and comparable 3 is 0.69%. The inventory divided by sales for comparable 1 is 0.32%. However, comparable 2 and 3 don't have inventory in their report. Next. Median fee comparable for 5 years is 5.05% for account receivable and 99.2% for cash. For Sunway, which is our subject company, the percentage for account receivable is 3.22% and for cash is 2.63%. The adjusted percentage we get when the median fee comparable for 5 years deduct the median 5 years subject company. The adjusted percentage is 1.83% for account receivable and 96.57% for cash. Next, we move to balance sheet. The total asset for auditor is around 8,158,000,000, and after we do adjustment for cash 96.57%, account receivable 1.83%, plant and equipment -10%, and investment property 20%, the normalized total asset is around 9,839,000,000. Next, total liability and equities for audited. Next, the total liabilities and equities is 8,158,000,000. That same with the audited total asset, and the adjustment for unit holder fund, which under equity is 37.74%. The adjustment for equities we get when the total asset normalized minus the total liabilities. The total normalized for equities is 6,478,000,000, which will become revised net asset value for company. Revised net asset value per share is 2 ringgit and 20 cents. Therefore, the FME of the company is around 6,478,000,000. Next. Next. Next, sure. As you can see on the slide, this is the fair market value for each approach. Asset is around 6,478,000,000. Market approach around 7,319,000,000, and income approach is around 10 billion. Next. First, Sunway is an income generating company, so we had to send the fair market value of income approach. Next. To conclude, the fair market value we can say is 10 billion for Sunway Real Estate Investment Trust. Next. That's all from us. Thank you.
Okay, I try to show your income statement analysis. Yang tadi tu yang the company's performance for the past 5 years. Okay, this one. Why don't you use 2020 data?
Because for the comparables, we have we have comparables that without financial year 2020 annual reports. So we use until 2019.
But for the subject property, the 2021 is already available.
Yes, correct. But comparables is not there. So we use the standard against the benchmark that we use as a guide.
So if the subject property is available 2020 by right, for the subject property, you still need to use latest report 2020, and as far as the comparable is concerned, you can do the forecasting on the growth. That's why we analyze the past 3 to 5 years performances, because if you look at your subject property, which subject company, which is Sunway REITs, their end of financial year is 30th June every year. And then their latest 2020 report has been published on the 28th of August. So by right, you should use the latest financial data, because you are doing the normalization, common size analysis on the company. So as far as the ratio is concerned, data on the subject company is more important as compared to the comparable. Comparably, we just want to see whether whatever we have decided later is reasonable or not. I think the way you do your this one, why you put operating expenses negative 24.84%?
This one. Expenses is -1, so it's a deductible. So we put minus as the sign
No.
To deduct from the income.
How do you calculate your analysis? It is the line figure over your total revenue, right? So by right, when you present your figure here, you should not put the negative in front of your figure, because it is the percentage of your operating expenses over your gross revenue.
Oh, okay, sir. Noted.
And then because when you do all the analysis, at the end of the exercise, you should get back the total percentage 100%, because whatever you do, the analysis there is the line, the item over your total revenue. That's how you calculate the percentage of the gross expenses, blah 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 blah.
Okay, noted.
I don't have no more question, because the rest is same with the previous groups.
Yeah, the mistake is repeating, yeah, from one group to one group, but it's okay, yeah. Just bear in mind, yeah, of the.
Right. Thank you, Dr. Su. I don't know, Dr. Zai.
Okay. Any other question from the student? If not, we have to wrap up, yeah. Okay. No question. If no question, I want to wrap up first, and after this, Dr. Zul. So for me, actually, I'm quite impressed with what have you done. Yeah, that means you understand. Yeah, about the market approach, asset approach, and income approach. But then, especially for the market approach, please bear in mind you have to find the similar property. The property, not property, similar company, yeah, which if the adjustment is more than, it's like 1,000%,
Untuk slide,
bear in mind that you cannot do that. It's not similar, yeah. It's far away from your property. Ini I tengok adjustment ada sampai 1,000%, yeah, which is, that means you kena keluarkan. It cannot be taken, yeah, as comparables, yeah. And then I understand, yeah, because due to this COVID-19, yeah, you cannot go on site, yeah, and then you also have barriers in getting some information. That one I understand, so don't worry too much, yeah. But please be realistic, yeah, be realistic. And then like some comparable, I see your company is food manufacturing, yeah, food. But then you compare with drinks, maybe it's not comparable enough. Yeah? So bear in mind, the comparison must be comparable. Yeah? It must be correct. Jangan simply ambil je. Kadang-kadang your reason is you said because of the market cap is about the same. It's not that. Yeah, you have to look into consideration all the characteristics of the comparable properties, comparable companies. Overall, very good. You have done a good effort, yeah. And after this, yeah, please upload your PowerPoint, yeah, what PowerPoint slide and your is that peer assessment form, yeah. I will put the link in Spectrum afterwards. Okay, thank you. Okay, Dr. Surveyor Zul,
I think since this subject is a basic or introduction to business valuation, so whatever you have gained so far is sufficient lah for your knowledge as a basic knowledge in business valuation. If you look at the scenario out there, this business valuation is the competing field between an accountant, a valuer, and a legal practice. Because when we are doing business relation, it involves intangible asset. Because to my surprise, none of your groups did mention about intangible asset for the company that you have valued. Definitely, the company will have intangible asset, at least in the form of goodwill, but none of the group mentioned about the goodwill, because goodwill has impact or contribute to the
dia masuk dalam calculation, tapi dia tak.
If your company, yeah, the calculation, but when they presenting, they should highlight. They should highlight, because that is the one of the main element of business valuation. That's why in practice, in reality out there, not every valuer is brave enough to do business valuation cases, even though they are most experienced valuer for real estate or property valuation, because doing business valuation involve a lot of stage. It is very difficult for you, as you experience doing your assignment, in collecting data on the business that you are going to value and on the comparison. Because as you witness, some of you just simply get a company without investigating whether the characteristic between the comparables and your subject company is same or close enough or not. But it's okay, because at least you are aware that what is a business valuation is all about. To me, when you graduating in few years time, and when you join the industry, you will need to have experience at least 10 to 15 years before you will have the opportunity to do business relations. So for the next 10 to 15 years, you still have time to learn about business relation in a real way. How do people out there do business relation? But the main thing is, don't forget about the basic principles, as we mentioned just now lah, about the basic principles of market approach or asset-based approach or income approach. So the basic principle has to be correct, regardless whether you cannot get the data or not. Different issue, but the basic concept or basic way to do market approach, income approach, or asset approach has to be correct. That is the most important thing lah. You have to bear in mind in doing business relation. So good luck lah, because business relation is a new thing in any part of the country in the world. So people still learning about business relation. What is the best way to do business relation? So we are in Malaysia pun still learning on how to do a business relation in the best way. As far as your learning process is concerned, it is good lah for you to have the opportunity to learn, to know basically what business relation is all about. Congratulations, even though there will be ada benda lah yang you kena betulkan sikit-sikit tu, tapi it's okay lah, because it is part of your learning process. Overall, as Dr. Zai said, you have done a good job in trying to fulfill the requirement for this assignment. So on that aspect too, you should be proud of yourself lah, but still you need to be careful. And ada some aspect that you need to do apa ni lah, because ada yang nampak macam clearly mistake dekat situ, so you have to avoid lah kalau yang clear mistake tu. Macam tadi, the way you put negative kat situ, by right you shouldn't put negative in front of the figure, because it is percentage whatever items from the total revenue, benda-benda macam tu ya, small thing that you have to consider. You have to be very careful lah. Bila you present dekat slide tu, people can see your mistake. Sometimes when we are the person who do the thing tu, kalau kita tengok benda sama, we cannot kita punya mistake. Itu sajalah.
Okay, congratulations. So today is our last class, yeah. But then you still have replacement class with me next week. Other than that, congratulations again.
I think for my part, if you think that you need revision before you sit for your final exam, you can arrange lah to have a revision slot with me before before you sit for your final exam. On my part lah.
Okay, if you have any problem, just inform us. Okay, thank you.
Thank you. Thank you.
Thank you, Doctor.
Thank you, Doctor.